Hi, Warriors. New week, new day, new attitude. Hello, Mike. How are you? Ingmar, how you doing? Bran, Kman, Ryan. Okay, so getting a little bit of a pullback in gold. I was looking at this and then we'll move on. But when I started looking at the daily last night, it's still possible that this could be a failing rally and that we could have one more decline and still clean out those 2280 lows. Silver also a lower high after a fantastic week. It still looks better um, than gold. Gold silver ratio still looks very weak. So we'll see what leads. If I'm correct on the downside, it should be gold, but silver could always play a little catch up. So let's get to the French elections. And Ryan, good morning. How are you?
Morning, Dale. How you doing, mate?
Okay, so you know, uh, I guess it was a result that really did not disturb the foreign exchange market. After last week, this euro only being down 4, and actually, I think the dip was bought last night. Still looks okay to me.
Yeah,
Um,
yeah. It looks.
so
It looks. I mean, it was a bit of a shock result. Everyone moved from the right to the left. Um, so yeah, there's a hung parliament. That's the long and story short. There's a hung parliament. There's not enough numbers in play that anyone can get a majority unless they all start partnering up. And pretty much all of them said they're not gonna have a coalition with anyone else. So we're in hung parliament. The euro's giving it a big fat bothered. French assets at the moment looking all right. The CAC opened down, but now it's back up again. So everyone's like, well, no one knows what to do. So move on until they get something they do know what to act upon.
okay. It's interesting because I know a lot of people. I know there were some other people looking for, a false breakout in gold. We won't know unless it's back under this level, 2360, to negate the breakout. Then it becomes a false breakout. So I'm anticipating that it will. So you won't have confirmation until it actually does it. But, I have a view that there's going to be a decent break in metals, but I'm bearish a dollar at the same time, which is conflicting on the
Yeah.
normal correlation. I think the surprise might be that you could have a pretty good pullback in gold, maybe even risk in the S&Ps, and that there isn't a flight to quality or safe haven buying of the dollar. Do you think we could be entering, which would be a different stage that we've seen in a long time? I can't remember it. I can't remember the dollar going up and gold going up at the same time. But I can't recall a time where we've had um, a dollar decline and precious metals under pressure. Can you come up with a narrative how that could work out for me?
Um, yeah, he's a bit of a tough one. I mean, it's you have to understand what's keeping gold up, and we knew there was plenty of Chinese buying going on. That took us up from the 19s all the way to the 2000s, but it's gone sideways since. So they're probably still buying it. But when you play the gold dollar trade, or you look for that correlation, you have to understand what's causing the dollar to move. If the dollar's moving south because the US economy is softening on its way down, what does that do for gold? Does that then give you a gold breakout to the upside, as you say, a bit of get out of US assets into something safer, or does it come down as well on the relationship? It's a tough one. It's a tough one.
Yeah.
You have to look at the last 3-4 months and how it's reacted to the fundamentals, and it hasn't really. We're stuck in this 23-2400 range, and that's come through strong data, weak data, Feds, and the whole
Yeah.
lot. So I think gold is not playing to the fundamental tune; it's playing more to the whoever's deciding to keep buying it tune.
Okay, what whether it's central bank buying or if so
Yeah,
they could Chinese could stop buying and confirm it in another month that they didn't come in, and the market could sell off, and yet the dollar could sell off too, because here we are on the dollar, and this trend line that I was talking about last week was tripped. My belief that trend lines have a destiny to be broken. So here's one. Okay. The big one is the one that's anchored back at the end of last year.
yeah,
And that comes in right around these moving averages at 104 and a half or so. Now I'd expect a bounce, but to me, it looks like this is a big failing rally. Okay. And to right the ship, it would have to probably start trading back over 106. So it's actually a pretty tight risk trade. Especially if you get a pop up there with any of the numbers this week, and then risk last week's highs or the 106.50 highs. Um, Looks to me like 102 is viable if we break 104. So, uh, and I think this could end up being something that lasts for, if we get this breakdown, weeks, if
yeah.
not months. And the true breakdown in the dollar, I know I'm looking at shorter term stuff, but you really can't say you're going to have a breakdown until you take out a par, right? Because I mean,
Yeah.
that's the range, right?
Can, can
So,
you can you see it breaking part? I mean, if you look at that rally that you got 2021, 2022, that was on the Fed
yeah,
going from 0 to 5%. Now even if they start cutting, they're only going to cut what, maybe a total of 200, 300 basis points at most. Is that going to get
yeah.
you back down to 90s, or maybe just around that 100 area?
Unless it could be political uncertainty in the US.
Yeah,
Okay, so if people were worried about elections in the UK and France, and I had someone ask me that, well, Dale, you're bearish a dollar, aren't you worried about these elections? And I said, well, can you think of a place anywhere on the planet that has more political instability than the US right now? I can't.
yeah.
Okay, we don't even know what the Democratic ticket is going to be yet. All right, so that's a possibility. Uh, getting back to yields, if we take out 420, this is a descending triangle. So have you noticed, and I'll bring K in too, that, like I'm looking at this Canadian as a big descending triangle, right? Okay. This is
Hey, good
just a
morning,
big ring.
Dale.
Huh?
I said good morning, Dale. I hope you're well.
Oh, I'm okay. I didn't sleep much last night. But this is a descending triangle, and the 10-year is a descending triangle
Do you
off
think it's a
these
case
low.
of Do you think it's a case of the market's got its head in the sand regarding the US elections then right now?
I think that regardless of what Paul says, and he's next week, right? The
No,
Fed
this week,
next week,
Tomorrow.
tomorrow, first
tomorrow.
one. Yeah,
Yeah, tomorrow he's talking in front of the committees, tomorrow and on Wednesday.
Oh, okay, so good. Let's get it over with. That the market um, is taking rates lower, just like the market took rates higher. So I don't know if he's going to ease, but if we take out this 420 level,
Hmm.
and a week or so ago when it did this, I started to lose confidence in that count, but I still think that we're going to do that, and that's going to take you down to 358. So what's that? Is that one cut, two, three,
Down to where you say?
three and a half?
Well, that's more than a few cuts, huh? That's 3 or 4, because the tens will probably, unless we see very negative US economic data, the tens may go a bit slower than the twos, for instance. But the market has already started to reprice September. I think this end of quarter thing has thrown the a bit of doubt in a lot of people's minds. But then in the end, it was just that, the debate and the end of quarter, and now we are back to where we were before, and now we will have to decide whether we break that 420 or not. For the time being, just in the middle, softish data, yeah. Not yet falling out of bed though. The yellow flags are turning orange, but not red yet. So do we need to do more than what we do now?
Well, you could just wait for a 420 close to go with it.
Yeah, I would do
anything in
so.
here, you just have a bias, and or you could say there have been two lower highs.
Yeah.
Right. So,
Yeah.
rallies are getting sold.
Yeah, and also this week you have the combination of Powell, the CPI coming out on Thursday, and then we are again in an auction week that is an auction schedule that is more important than last week. So I think it's again a case of wait and see. Does it break either side, and then I think you go with it. Yes. Because there as well, TLT, you broke up and then you print a high, and now now we are like hanging around and waiting what to do. If you look a bit left before that broken trend line, we are sort of back in that traffic zone, right?
Yeah.
Yeah.
So
I think on gold, you were showing gold earlier. For those who really trade very short-term ticks, we held where we had to hold, just around 23.68. I think 23.5 is going to be where it's decided now or not. It's going to be directed again now by the yields and yeah, whatever happening in geopolitics probably. But what we saw here today, we had this little peek into Friday, right? And I think it had to do a lot with the uncertainty surrounding geopolitics and politics into the French election. It looks like, and I said the same thing on the Flow Show, looks like we had this spike into Friday, a bit like you would trade with FX option volatility. You have volatility is trading higher into an event, and now this risk is gone, so you don't need the high volatility anymore. And gold lost $20 in this morning, or from Friday evening into your morning, and now we are stabilizing again. I think if we hold this 2360s or 2350s, it still looks good in my opinion, though.
Yeah, 2350 is what it needs to negate this triangle breakout. And then if I didn't have the line here, you could say, well, look at this rally. All it did was take out these highs. There could be some kind of flat, where we could maybe not with this type of velocity decline, but we could decline. So if there was ever a spot, I mean, who went home short gold or silver? I don't think many.
No.
So, anyway, just
something.
Go ahead. What?
Do you have to be short? That's the thing.
Well, I mean, they took
back
out at
23.5. Then I think, yeah, we are going to go back to 23, 22.90, perhaps. But for as long as it holds, I mean, this is just a bit of a setback,
Yeah. Yeah. Yen, what do you think? That was a little shallow pullback. Do we go for 64?
Yeah, 160.25, the prior highs, and it's holding. It's holding already 3-4 times now. That's an easy one to
60-20
watch. And I think in the short term, 160.25, 161.25, and then we'll see. But again, it's same thing happened as in gold. On Friday, dollar yen went down, and it looks as if that was temporarily, at least on the risk train, in FX. Now the risk is over, and dollar yen this morning spiked, and all the yen crosses are still like so big. I mean, I was showing it this morning on as well. And when you trade dollar yen, you cannot not look at the yen crosses. They are actually, I think, bigger drivers than the dollar yen is right now.
Okay.
All of
You
them.
want
I mean, euro yen, sterling
you
yen,
want to take the charts and go over them with the
my
community?
charts.
Yeah.
Okay, but
How about you?
I'll,
Uh, do you?
yeah, come on, give it to
All
me.
right. Okay, we got a special treat. Look at Case.
Special
I've seen
treat
your
on the
work.
top.
I don't know why you're laughing. I think it's pretty
Yeah, right.
interesting.
Okay, here is your dollar yen, okay?
Yeah.
Let me show you up. Let me put up the chat as
See,
well.
people miss the rainbow charts.
Yeah, Brand misses them. But Brand, you can see them on the flow show, right? So this is your 160 and a quarter, all right? That spike that we had in
Yeah.
April.
Right.
Once tried to get down there again, spiked. Well, went back up twice, went back up. Then we did this new high. This is one that comes from a little bit longer term. So that's that, and it also coincides with those little spikes before we did the other top. And that's around 161 and a quarter. That's what I'm looking at. But then look just simply at euro yen. We came down a
Yeah.
bit and we are back towards the high. Look at Aussie yen. Aussie yen correcting a little bit, and we are back at the highs. So when you trade Kiwi yen, exactly the same thing. You get some corrections, and you're back at the highs. Sterling yen, ditto. I mean, those are the ones that I want to watch all the time. You have a dollar part in the dollar yen, but you have a big cross part in the yen as well. And for as long as those crosses are holding up, why would you actually sell dollar yen, right?
Yeah.
Okay, the
Okay.
gold. Gold. So we had this break. This is the similar line that everybody has.
Yeah.
Had this break higher.
Right.
This is the top from earlier in June. Okay, so and this is now coinciding with the 23.6 of the move higher that we had from below 2300. Yeah.
Yes.
So first, it held today. That
Yeah.
on the intraday is already good enough, I think, for now. But I would not rule out a move back down to 23.5, with Powell, with CPI. I actually wouldn't mind, and then see what happens there if I need to reload or get out of a part. But we have this big traffic zone here now, anywhere between 23.50, 60 and 22.90. This is going back into May, okay? But even before May, we had already this traffic zone, okay? So I think this is really you how do you call it? A distribution zone, or this is where the market is relatively neutral right now. But then if you look if
Yeah.
you back onto a longer term chart, yeah, I know I should these are my spaghetti and rainbow charts, Brian likes. But if you look back onto the longer term, take away all those lines, we are consolidating at a relatively high level, right? So
Or distributing.
yeah, that's why I think that unless um, we get some real reasons for the U.S. Yields to go back up. So that means that what we saw now, those yellowy, orangey flags that we have in the economy now, call it housing, call it the jobs market, call it the ISM that came down. Unless we get a reversal of that and the US starts to go up again, I still think this is a preparation for a move higher.
Oh,
That's how I
gotcha.
look at it right now.
Okay.
Right now, if we get back below 2280, 2270, all bets are off, and then we're probably going to go quite a bit lower. But for as long as we're here, I wouldn't stand in front of it, to be fair.
You think it could be a head and shoulders top, and that's a right shoulder that we're working on?
One,
Or
two,
is it
yeah, then you go and retest 24.5 and fail. 24.25 and fail.
okay? That's if it's completely symmetrical to the other one.
If
Yeah.
that's the one, yeah. Otherwise, if
Yeah.
you have a hunchback of Notre Dame head and shoulder, you may
Yeah,
already.
Quasimodo top.
Yeah, the Quasimodo, yeah.
Yeah.
And you're
Seen
going
a few.
what? Your neckline is going to be at around 2,300, huh? 20,
Yeah.
those $10, give and take 2,300 and below are going to be critical.
Okay.
Um,
Any view on risk here? Okay.
Where is it? Here, my S&P. Why would you fight this, right? Why would you fight this? Why would you stand in front of this? 56.40 is where my next double fib action comes in.
Okay.
But for as long as we are above now 5,500, I mean, it's, you know what, it feels to me like trying to fish a top in dollar yen, you know, this S&P.
Yeah,
And we are
it's a
also
good point.
entering earnings season as well, right?
Yeah.
And the expectations are that at least for the banks, it's going to be a good one. And so I don't think that the market is willing to start equity markets before we know towards the end of the week what the results are from JP, Citi, and the likes. Yeah, ForexAnalytix, I do use clouds at times, but I didn't see much that is really in or close to clouds right now. Perhaps the
Do you
dollar.
think the market is running on a probable Trump victory because he's perceived as being better on tax policy
I think
and the economy?
we had two attempts to trade them. The first one is February, where he won
Nomination.
the Republican
Nomination.
nomination, yeah. And then the second time was those debates with Biden. But I have the impression it's so far only equity markets have really perhaps went onto the Trump bandwagon. The rest is still trading different things. The dollar, for instance. Well, first of all, the little dollar rally that we had after the debates is very, very short term for me. I don't think that we should trade a higher dollar on the back of Trump, because it may end up being a bit of the opposite way. The dollar may actually suffer. Equity markets short term, certain equities will probably enjoy it, but I'm not sure whether the dollar is going to enjoy much of it for very long. You know, with either of them, to be honest. Purely on the election, but I think we have to trade other stuff before. We can't look besides what's going to happen in the meantime on the central bank front, right? And if Powell really continues to talk like he did in Sintra, that may getting closer to a decision, then their dots were completely wrong on the prior FOMC meeting. And although the market has already repriced a bit, there may be some more to be done.
Okay.
Last one, and this one is interesting, the dollar Swiss, because Swiss is a currency that should still remain under the cush, but that is to me also a good barometer for the dollar right now, because if you're trading a currency that should, in theory, remain weak, and you start to find this kind of channel where the dollar doesn't succeed to break higher, this may be a confirmation that the dollar is not ready to yet recover much more. Because I think if the day the dollar, we need to reprice the dollar, and the dollar puts in a recovery again, I think this dollar Swiss together perhaps with dollar yen, but this dollar Swiss is going to break higher again. And for the time being, this is one that I'm watching, and it's not showing us that.
Okay, is there a pound Swiss trade out there because of the soccer game?
No, I don't think so. Not on the
If
back
ever
of the
Ryan could
not on the back
Ryan
of the
could come up
soccer.
with
No,
one.
no, 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 no.
All right, thought there might
Okay,
be.
back over to you.
Okay, so let's go back to Ryan. Your view on risk, Ryan?
Risk, not a lot really. There's a lot of political risk around, obviously. For now, it's just about what Powell has to say. You know, how's he going to spin this potential weakness? Is this jobs market data that we got Friday that everyone keeps saying is soft? Is it soft enough to tip them into cuts? You know, he changed his tune a bit in the Sintra meeting. But for me, that data Friday isn't bad data. I don't think it's enough to push them to cuts. It's not weak enough. But that's the risk the market's going to look at. We get his testimony dropping the lines from it an hour or so before his testimony tomorrow, and the market will be looking at that to see if there's any additional comments in there that we haven't heard at the FOMC or his last outing. But yeah,
Okay.
the risks in play are still there. Politics, Ministry of Finance for the yen, UK. I'm expecting maybe to see the pound keep its bid because it's a island of political stability at the moment. Touch wood compared to some of the others. So I'm expecting that to continue. And we've just had the first Bank of England speaker out today because they've all been muzzled while the election campaigning was going on, and Haskell wasn't exactly forthcoming that a rate cut is coming anytime soon, but we've got two others coming on Wednesday who might have a different idea because everyone wants to know what's happening with a rate cut in August.
Okay, I just want to touch on Canada. You know, we've been here a million times.
I'm on your side now.
Huh?
I'm on your side. I'm a bit short in this one.
Okay, and really the real signal doesn't come until under 36. You know, I have a lead on it. If there happens to be a rally, I think 680 is a decent level with stops over 38 because under 136 it measures 33 and a half, I believe. Yeah, 33 and a half. And I mean, this is as classic as it gets. That take you to 3.5. There's a lot of weekly support at 32, 31 down here. So if you take it from 140, you know, you're talking 131 or so, which is back down here. And just a couple of issues with the market that no one's saying anything about is with these, and something I brought up a month ago is with the S&Ps and NASDAQ making consecutive higher highs. I don't think this happened before. Normally the Dow would be there too. And the other thing is when we came into the beginning of the year, there were so many people bullish Russell, you know, and we had a decent January, but it's gone nowhere. I mean, there were guys like Tom Lee talking about it doubling, David Hunter too, and it doesn't look that great to me. I mean, it's sideways. You know, if we get back over 208, it'll look good, but when you look at a weekly, maybe it's a monthly. Look at the monthly.
You know, is this the sectorial divergence we're starting to see in play now? You know, tech stocks are obviously floating around in their own, you know, fairyland.
Right.
But real, you know, bricks and mortar stocks, shall we call them? You know, if the US economy is weakening a bit, you'd expect a bit of underperformance there, wouldn't you? Or,
Almost looks like the dollar, doesn't it? You had a big break and you've moved sideways. You know, so you know, this doesn't look
those
great.
might be the signal, you know, that people are taking note of a weaker US economy.
Yeah, and I also heard that someone who forgot who the guy's name is, but you know he does market coverage every day, and he said that they're going to stop covering the S&P and NASDAQ because they're not representative of the market.
Yep.
It was a joke, but true too.
It is true.
Yeah. So anyway, you know, in the KRE, which is a big part of it, and I'm going to ask Joseph Wang is with us today. I'm going to ask Fed guy about it, but you look at the KRE, it looks worse than the Russell. Okay. So, I mean, all we did in KRE was with this huge rally that we've had since last fall, October, is basically just get back to resistance. And all we're doing is moving sideways. Is it consolidation for another rally? Or is this just a bear market rally before we head down again? So
It'd be interesting to hear what Josie's got to say about it, because obviously we've just come through all the Fed stress tests.
yeah. Oh, he
But
says they're sound.
yeah, they're sound, but they're all the big banks, and
Yeah.
most of the CRE risk is with the regional banks that don't get stress tested.
Yeah, that's what I mean. So they're sound. The regionals are soundproof, so you can't hear the officers and
Can't hear the
traders
creaking.
in the banks yelling and
Dale,
screaming. Huh?
have you already, or should I try to promote Joseph Wang?
I haven't done it yet, but sure,
I
you
I
can do it.
promote. Well, I hope it worked.
Let's see.
Yay! It did.
So
Lovely.
he's here
Yeah,
and he's promoted.
promoted.
Okay, great. So
Whoops.
yeah, everyone stick around and listen to Joseph here, especially with the Fed coming up this week. Joseph worked at the trading desk at the Fed. Are you with us, buddy?
Yeah, hey, thanks for having me. Can you hear me?
Did
Oh,
you are you
What is
taking helium this morning?
Oh, it's something about, oh, I see. Strange thing happened with the mic
What is
there.
that?
Have I gone to Diz? Did you turn into a munchkin?
I think your kids have been playing with your settings, mate.
Yeah,
Let me see.
yeah, there's
What
something
the
wrong,
heck?
bro.
Okay, I think I can fix this just
Oh
a
yeah,
moment.
that was a great.
That was quite a start.
Okay,
I
is this better now?
knew I had not put any mushrooms in my coffee. So I'm glad you got it straightened out, Joseph. Great to have you back on F.A.C.E. How have you been, buddy?
I've been doing well. Thanks so much for inviting me. It's a pleasure to be here.
Okay, well, you know, it's great to see you. I'd like to start off with why don't we go with the elephant in the room? Your expectations for Powell's Fed this week?
Yeah, so I think so the market, just for context, right now, the market is pricing in 2 cuts this year, first cut starting in September. And I think that makes sense. And I think there's a risk that we can have probably 3 cuts this year. So the way that the Fed is looking at the world, it's about full employment and price stability, right? Now, when I
Yes.
read the Fed minutes, I'm getting the sense that there is some degree of polarization on the Fed's decision-making body. You have a group of people who are just saying, hey, look at unemployment rate, it's going up. Recently, we just got to 4.1. We got to pay more attention to our unemployment mandate. But you also have another group that is a lot more hawkish, and they're like, we still reserve the right to hike rates and so forth. So that
Yes.
degree of polarization, I think it's going to make things a bit more difficult for Chair Powell going forward, but the data is clearly moving in the direction of a slowing US economy and a more balanced approach where I think unemployment is going to be more important than inflation. Now, the
Okay,
Fed's
so
target, of course, is 2%, but if you look at the data, we're at 2.6%. We're really not that much above the Fed's target. It doesn't seem to make sense for rates to be at 5.5%. So I think the risk is that we'll have more than 2 cuts this year.
okay. Could that take the 10-year back to 350? Because technically that's what I'm looking at here with this formation here. It's a descending triangle. And I could go back to 5% if I wanted to be more aggressive on the call. but 470 to 420 is 50 bips, and 420 is a breakdown out of this formation, and you subtract 50 and you have 370 on the 10-year. Can you come up with a narrative that would get them there?
So I think that we haven't seen the lows. So I think we can go see 4% on the 10-year, because I do think the market is not pricing enough cuts at the moment. But I think much below that to me seems difficult, because structurally speaking, there's a couple of things that I think that are going to have a secular upward trend in yields. One, of course, is that you have inflation that still is not going to go back to, I think, 2% or below. Will probably be around 3% going forward. It's going to be volatile, but it doesn't seem like we're going back to that same regime we were pre-pandemic after the GFC. And the second is that we have tremendous amounts of deficit spending that's increasing the supply of treasuries. So you got to have that higher term premium in the treasury market. So I would say that if 10-year will go down to 4%, I would sell it. I would think that longer term, maybe within a few years, maybe within a year, we should see 5% on the 10-year again.
Okay, so this is just a temporary move to the downside in yields. The long end of the market.
Let me actually give you a little bit more color on that.
All right.
So when we talk about the 10-year yield, the market often thinks of it as, say, just what is the neutral rate for the economy? Where is the interest rate where the Fed is neither being restrictive nor accommodative? Now, I would expect that the 10-year, let's say the 10-year yield being an average of the path of policy over the next decade, it should be about not too far from the neutral rate, and a little bit above, because you need a little bit of premium to compensate you for duration risk. Now, the market is thinking that the neutral rate is probably, say, 3.7%. It's volatile, but it's structurally higher than it was pre-pandemic. So if you think that the neutral rate is about 3.7%, you add 100 basis point of premium, that gets you pretty close to 5%. And honestly, 100 basis points of premium is not a lot. And given the projected fiscal deficit, I think it should be higher.
Okay, so I want to move on now to something you blogged about, Joseph, and you use the title French Connection, like the movie. And you're talking about France having a big impact on the dollar. Can you explain France's role in how you're analyzing the dollar and what impact looks like the elections hung parliament? What you think, what you're writing about then about France, is it still valid after the 2 weekends we had elections?
So when I think about what's happening in France, I think about its connection to the US via the global banking system. What many people don't realize is that France is actually home to a few global mega banks that are very active in the dollar funding markets. And what these global banks do, say a BNP or Credit Ag, SocGen, is that they will go borrow dollar funding throughout the world and invest in short-term arbitrage in dollar assets. It could be as simple as borrowing dollars somewhere and then just leaving it on deposit at the Fed, earning the spread between what you borrow at and what you earn in interest on reserves. Or it could be a little bit more complicated, where you would borrow money, dollars, and then lend it in the FX swap market. So the French banks serve as I think, a significant arbitrager of these dollar funding spreads. Now, what we saw when Macron called the French election is that we had turmoil in the French markets, and we also had some of these dollar funding spreads widening out a little bit. Now, that seems to be greater caution due to the banking sector, where if you have banks that are a little bit more concerned about the market, or they have less capacity to arbitrage, and so you could have spreads, let's say spot swap spreads, FX swap spreads, just kind of be a bit bigger than usual. Now, that seems to have the market seems to be a lot less concerned now. If you look at oat spreads to German bunds, it seems to have narrowed a bit. So I'm getting the sense that the market is happy with the hung parliament outcome that seems to be unfolding before us. So that takes away a lot of tail risk.
I know you pay attention to currencies, and you have generally you have a view on the dollar. I'm pretty bearish, especially if we take out 104.5 here, Joseph. We tripped one trend line here last week. This looks like a failing rally to me. We get through 104.5. It opens it up for more downside in my work. And considering what happened in the UK, normally it's bearish when Labour takes control. It may take some time, but I see nothing wrong with this British pound chart. I wouldn't short it. Your view on the dollar and my other view is that commodity currencies are the leaders. Aussie, one of the strongest out there. USD NOK under pressure, just like Canada. They both have oil in common. You have a view on the dollar, either as the dollar itself or in pieces, any particular fiat that everyone says is eventually going to be worthless, but I'm going to trade it until then. So you have
So
a view?
I agree with you. I think the dollar, there's some big things that are quite bearish for the dollar. Well, for example, one of the Trump traits is a weaker dollar, right? Now, betting markets give President Trump 60% chance of retaking the White House. President Trump, very open with you. He wants lower rates. He wants a weaker dollar. Now, he can't directly control the Fed, but he does have direct control over the currency. That's one of the powers of the US Treasury. So if he wanted to depreciate the dollar, he has all the tools to do that, doesn't need anyone's approval. If he wants to do that, and I think he does, then you could see a weaker dollar. But even if he does nothing, like the fiscal policy, the fiscal trajectory that we're on, significant deficits, that's obviously very bearish for the dollar. So yeah, I think the dollar is not in a good situation. We could still have these counter trend rallies where we have global risk off events, but I think that government is telling you they want to depreciate the dollar, so I would take them at their word.
Yeah, I think it's going to be interesting since we haven't seen risk off for a while to see how the dollar actually does respond. I think there's a possibility that we don't get that safe haven buying in the dollar, especially if things look pretty messy here in the US. Could you come up with a narrative, Joseph, where we could have a weak dollar and risk off at the same time?
That will be a very negative view of the world. That's what you would see
that's Paul's nightmare, isn't it? A weak dollar and risk off.
So the way that I think this could happen would be, let's say that you tell the world that you want to depreciate the dollar. And if you are a foreign investor, you care about your returns in local currency terms, right? So right now, if you are a Japanese investor and you bought US stocks, well, great. S&P, NASDAQ went to the moon and the Japanese yen depreciated, so the dollar appreciated. You're getting a double play here. Now, right. If you reverse that, saying that, well, let's say that the dollar, the administration wants to depreciate the dollar. Obviously, as a foreign investor, you don't want to take those losses, right? Because you're looking at things in local currency terms. So that could prompt you to kind of get out of the U.S. market.
Okay. I want to talk about
you would have a dollar sell-off and also risk off.
That would be an even more difficult backdrop for treasuries, wouldn't it?
So for treasuries, I think that we're on the path towards some kind of accident in the treasury market, but I wouldn't really be worried about that a lot because there are a lot of tools that the government can do to fix the treasury market. We've already seen people roll out this across the world and in history. Remember what happened in the UK a couple of years ago? You have an
Yeah.
accident in the Treasury market. Bank of England comes and just buys a
Right.
lot of gilts. If you have an accident in the Treasury market, Fed could do the same thing. Fed has done it before, all throughout the 1940s. You have some form of yield curve control, active involvement of the central bank. Now, these rates markets, these are things that are basically within the control of the government. So you can have accidents, but they will be short-lived.
Okay. You want to address how monetary policy is creating shortages. Are you talking about rates being an inhibitor for example, building new housing, developing anything new because, you know, the world got used to free money, zero rates, 1% rates. And so there are shortages because things aren't being built or mines aren't being opened because of higher rates. Is that the point you were trying to get
Yeah,
across?
yeah. So I think that monetary policy, interest rates, has an uneven impact uh, on industries and on goods and services. We want to think that if you raise interest rates up, you decrease demand, and thus you can slow the economy down and get inflation down. But inflation, ultimately, it's not just about demand, it's also about supply. So if
Right.
you have high interest rates, you are obviously going to constrain supply in some industries. Now, one of the industries that obviously gets constrained by high interest rates is housing. Now, if you look at surveys of developers, if you talk to developers, they'll tell you that they're not building a lot. And you can see this in the housing starts. You can see this in a lot of data. They're not building because with rates where they are now, their projects just don't pencil in. So again, people look at this through the lens of cap rates. If you have interest 7% mortgage rates, even higher if you're trying to get a construction loan, these projects just don't pencil in because the cap rates are too low. So you are also constraining supply as well. Now, it looks like we're at a point where higher interest rates could reduce the supply in some segments of the market and thus actually contribute to shortages and higher prices. Again, this impact is very uneven, but the way that the inflation numbers are calculated, there's a very big weight for shelter inflation, which is to say rents. So if you have interest rates constraining the supply of housing, and at the same time you're importing millions and millions of people, increasing the demand for housing, obviously you're going to push shelter inflation higher. In that sense, for this segment of the market, high interest rates become counterproductive. And you can also see the same thing happen in Canada, which is a much clearer example where they had tremendous amounts of migration, high interest rates, and guess what? The rent just went through the roof, and it's making it difficult for the Bank of Canada to get to their target, largely from their own doing.
Yeah, and also, Joseph, they don't have 30-year mortgages up there in Canada. I think
Yeah,
they're
one of
mainly 5 and 10-year that are rolling over. And as they roll over, rates are twice as high for the mortgage holder. And it's different than the US too. You can't just walk away from your house without having other repercussions like liens against having your salary garnished or other assets. You can't just walk away like we can in the US.
Yeah, so I think that's one of the big reasons that they want to cut rates, right? So they've cut rates once and they're expected to cut rates, continue through the cutting cycle. It's because monetary policy is a lot more effective for them. When they raise or lower their interest rates, that feeds through the mortgage market to households in a cleaner way, like the way that you described. And so you definitely have a lot of Canadians who are going to be surprised as they have to renew their mortgages in this current interest rate environment. That's
Okay, and their currency under 136 is going to strengthen. I normally that hurts an economy. Like if the euro turns good and I get things like, you know, 115, 120 euro in 6 months or a year, could that be the nail on in Europe's economy as exporters, which it's a big exporter Germany especially, has more difficulty doing so with the stronger euro?
So I think that, well, for Europe, I think when they think about exports, it's not just about to the US, but it's also to places like China and so
China,
forth. So
yeah.
that does seem to be impacting them. Um, about the currencies, though, again, like we discussed earlier, I think structurally the dollar is going to weaken, but I prefer this to play this against, let's say, weakness against financial assets, because when you look across the world, all countries have their own problems. Now, even though the US is definitely doing things to weaken their currency, maybe it would be more obvious to manifest in different ways, like financial asset inflation, or real estate, or things like that. So playing it against currency pairs for me has been difficult. For example, looking at CAD, everyone was saying that, seeing the points that you mentioned, Canada has to cut rates faster than the US and steeper because it's their economy is more rate sensitive due to the mortgage channel. But if you look at the Canadian USD exchange rate, kind of been range bound for the past year. So
Yeah, yeah, even longer. So yeah, it's almost been 2 years. Look at this.
yeah, and strangely, it looks like
Look at
someone is
that.
just defending that at 1.39. It doesn't want to go above that.
Yeah, and supporting it at 32. To me, it's just too long for me to consider this consolidation and accumulation. Looks more like distribution to me. That's been happening since 22. And so if you break the bottom of the range, it could usually be a pretty big move. So, that's what I'm looking for eventually. Right now, this 36 is a level, but the big levels are down here. And it's counterintuitive with a bad economy or an economy under stress. You would think that Canada USDCAD be going up and weakening, not strengthening. So uh, I need economists like you to explain what I'm seeing. That's why I keep you. Can you give me a narrative to explain what I'm doing? Uh, anyway, why don't we wrap it with something I haven't heard you write about in a while, and you're talking about crypto rebalancing, and it's kind of a positive development in the crypto world. You want to address that?
Yeah, so as we've noticed that there seems to be a relationship between crypto prices and risk assets. There's some interesting
Except
research.
for last month.
Well, not yet. So
Yeah.
except that, so people have looked into this and actually found pretty concrete links between crypto users and people and other assets. What they did was they looked at basically a huge database of 60 million bank accounts to try to figure out just what people do with their money. So they located among those 16 million users people who are traders in crypto. They did this by looking at their bank account data and seeing if they had transactions with big crypto exchanges like Coinbase. And they found pretty interesting things. One is that when people have big crypto winnings, they tend to buy other stuff. One of the interesting findings is that they noticed that when someone withdraws a whole bunch of money out of their crypto exchange, a few weeks later, their monthly mortgage payment goes up a lot. Now, the inference there is that, well, you took all your crypto winnings and you bought a house, a bigger house, and that's why your mortgage payment went up. And so you have this link where these YOLO crypto guys are actually, contributing to higher house prices. But what they also do is they also rebalance it to other traditional assets like equities. So that seems to be why there's a link where higher crypto prices, some guys sell their crypto and go and buy the NASDAQ and stuff like that.
Yeah.
Now, I'm actually kind of surprised by what's happening in crypto right now. You see this just doesn't look good. Bitcoin doesn't look good, but if you look at the alts, they look even worse. But at the same time, you have the major indexes doing really well. So that seems to be pretty interesting. Either the crypto is just ahead and we'll see follow through from the major indexes later, or maybe they're decoupling. I'm not sure.
Or maybe they're a warning sign that there might be a little liquidity issue, which would also tie in with rates coming off for a little while.
Yeah,
Or
that could be as well.
yeah. So I just want our viewers to know where they could find you and where I was able to come up with questions to ask you about based on your writings. And if you're interested in the dark science of central banking, no one better to shed light on it than Joseph. He has courses.
Yeah, so thanks so much for having me. If you're
Yeah.
interested, you can check out my website at fedguy.com. I also have a YouTube channel called Joseph Wang, where I will give you a weekly market debrief as to the big events that happen in the market every Saturday.
Okay, so there you go. I mean, keep Joseph's views as part of your intelligence gathering for what you're trying to figure out to do, especially in markets that are closely related to the Fed. But he's got across the board coverage, as you could tell. And I always feel like I've learned something new every time I talk to him. So again, my trading warrior brother, Joseph Wang, thanks for coming here again today and hanging out with our community and sharing your work with us.
Thanks so much, Coach. Good to be here. Happy trading, guys.
Oh, you did that on purpose. All right, Joseph. Anyway, nice talk. Nice talking to you, buddy. Talk to you later in the summer or the fall. Joseph Wang, everybody. And you could join the team in, it looks like 19 minutes on the Morning Edge. So we're in July. I don't want to hear about anyone starting to cry if they haven't joined our community. So good hunting the rest of the day, everyone. Oh, you're welcome, Mandy. It's fun for me to bring these guys on because the questions I ask are also questions, although I believe you want to know the answers, I certainly do. So who better to ask the questions than has been asked the questions? And appreciate that. See everyone for Turnaround Tuesday. I have Hal's Rethink tomorrow. So Harold Malgrim will be with us. I'm going to talk some politics with Harold tomorrow. The Donald Duck is unbelievable. He did that on, it was intentional. It's got a sense of humor. All right, everyone, don't just count on to Mandano. Don't just count your pips, count your blessings. See you guys tomorrow. Adios.